Welcome back. Today's 2026-07-20. Our AI system scanned 132 stocks and identified the 5 most important names to watch today. Let's get into it. Our system flagged ISRG today on a rare combination. Oversold technicals meeting questionable fundamentals. Stock is down 12.7% on 2.44 times. Average volume exceptional selling pressure, and the price sits 41.8% below the 52-week high. RSI at 31.28 is textbook oversold territory, typically signaling reversal risk. But here's the wrinkle. An earnings beat doesn't guarantee safety when procedure growth, the real growth driver for surgical device companies, is slowing. The system entered watch mode, not a confident BUY, because the technicals and the business narrative are at odds. This report walks through the data breakdown, what the technicals say, what the options market is pricing, and where the real risk lies. RSI 31.28 is oversold territory. Below 35 signals extreme buying pressure may be imminent, and Intuitive's history shows surgical device stocks due bounce from here, though magnitude depends entirely on the business narrative. Price at $351.24 sits below MA $50 $417.08 and MA $200 $486.59, both key moving averages in bearish configuration, which signals intermediate-term weakness. Volume at 2.44 times average confirms distribution, not accumulation. The data can't yet answer the critical question: is this capitulation in the procedure growth story, or a tactical overreaction to 1 quarter of slower guidance? That ambiguity is precisely why conviction stays low despite the technical setup screaming reversal. Support at $349.95 is where the model identified the last meaningful defense line, and current price $351.24 sits just above it, a binary structure. Either hold support and reverse, or pierce it and test $323.34 stop. Entry zone $349.95 $351.26 means the system sees current levels as the last place to initiate before conviction would shift to hold or reduce. Resistance at $443.84 is 26% above entry, marking the first meaningful target zone. Below support, downside to $323.34 stop is about 8% of capital. Above $443.84, the technical structure improves materially. The tight entry zone reflects the high stakes of this setup. The headline risk is procedure volume deceleration. Unlike valuation concerns, which can reverse on a single re-rating day, a slowdown in the core business metric requires a real catalyst to restore confidence. New product wins, geographic expansion, patient volume recovery. No near-term earnings catalyst on the calendar. The system flagged this as the primary risk. Without concrete visibility on procedure stabilization, this reversal setup may be a technical trap, not a true reversal. Institutional selling visible in the volume profile suggests money is exiting the thesis entirely, not just repositioning for a bounce. That's why conviction is low. The technicals look right, but the story doesn't yet support them. Put/call ratio 1.03. That means for every 1 call bet on ISRG rising, there's 1.03 puts betting it falls, slightly more hedging than bullish positioning. This aligns perfectly with the LOW conviction read. Options traders are not convinced this is a genuine bottom. ATM Roman 4 at 0.4214 42.14%. That is the annualized volatility implied in option prices sits at moderate levels for surgical device names, and suggests the market is pricing real uncertainty, not panic or capitulation. Call buyers at these prices are paying a fair rate, not an outsized premium, which means upside insurance is available at reasonable cost. If the reversal confirms, the options market is holding the same cautious stance as our system. Our system's read on ISRG: watch, up bias, LOW confidence. Entry zone $349.95 $351.26. Stop loss $323.34. Target 1 equals $413.41. Target 2 equals $420. Target 3 equals $550. Risk/reward ratio 2.23. System is monitoring for procedure volume stabilization or new product catalyst. Without concrete evidence of either, the setup remains tactical, not strategic. The data shows a textbook oversold setup colliding with a muddled growth story. Technicals signal reversal risk. Fundamentals suggest caution. Options positioning reflects the same tension. Our system is watching for hold above $349.95 and volume confirmation of any Reversal attempt. If procedure growth stabilizes or new product wins emerge, conviction would climb higher, and that is the trigger the system is monitoring for. Until then, this is a wait-and-see setup. Netflix just handed investors a shock. The streaming giant missed Q3 subscriber expectations and cut forward guidance, triggering a 7.42% single-day sell-off. When a mega-cap loses $12+ billion in value on one session, retail often panic sells. Smart money watches. The question isn't whether the stock bounced, it's whether this is capitulation or a bear trap that still has room to fall. Our systems read, the setup warrants a close watch, though conviction is low until confirmation. NFLX closed at $68.83, trading near the $65.1 support level. The 50-day moving average sits at $80.56. That means NFLX is $11.73 below that level, which signals intermediate downtrend structure. The 200-day average at $93.74 shows the stock remains 26% beneath its medium-term trend. Price is 46.1% below its 52-week high, suggesting either extreme capitulation or a value area where long-term buyers step in. Volume confirms genuine institutional selling, not panic noise. RSI 30.57. That is oversold territory, typically below 35. Which usually signals panic selling has reached an extreme, and mean reversion rallies historically become more likely. However, a critical detail, NFLX is down 46% from its 52-week high, which means the RSI can stay depressed for weeks during structural downtrends. Oversold does not mean buy now, it means watch for reversal signals. Our system is flagging bounce potential, but institutional selling may be unfinished. The trigger was Q3 guidance disappointment. Netflix forecast misses typically signal three fears: slowing subscriber growth, margin compression from content costs, or weakening pricing power in competition. The market isn't panicking about today, it's panicking about next quarter. Any recovery must address the forward story, not just bounce technicals. Until management clarifies re-acceleration via ads, tier strength, cost discipline, or geographic expansion, rallies may be dead cat bounces. Put-to-call ratio 0.659. That means for every dollar bet on the stock falling, $1.5 are betting it rises, which is a bullish options tilt. Smart money typically buys calls at extremes when selling vacuums appear. Traders increasing call bids while the stock is down 7% suggests snapback positioning. Don't confuse positioning with price certainty. This means asymmetric bets favor upside over coming weeks. Roman 40.418 needs percentile ranking to confirm whether options are priced cheaply or already pricing recovery. Our systems read on NFLX. Watch, up bias, LOW confidence. This means the model detects technical reversal potential, oversold, support near, bullish options, but lacks conviction, because fundamental catalyst guidance recovery is unproven. Entry zone $60. 5.1 $67.05 aligns technical support with reversal probabilities. Stop $60.82 invalidates the setup if broken. Targets T1 equals $76.5, T2 equals $78.44, T3 equals $110.0. Span wide range. T3 requires earnings reset. Risk reward 0.95 is near 1:1. This is a trader's setup, not investor conviction. Netflix is at a crossroads. Technical bounce potential is real, but it's begging for a catalyst. Retail often treat oversold stocks as automatic buys. Experienced traders wait for confirmation. Volume surge into support, earnings clarity, margin stabilization. The next 1-2 weeks will clarify whether this is a capitulation bottom or first leg of deeper breakdown. Watch management commentary on Q4 subscriber trajectory and ads tier monetization. Those key points separate V-shaped recovery from dead cat bounce. Lucid just got a massive gift this morning. The CDO personally shot down a bankruptcy claim that's been haunting the stock. Result? Up 29% in the pre-market, now sitting plus 7% on the day at $6.91. But here's the catch. The stock is down 79% from its 52-week high, and a single "we're not bankrupt" speech doesn't fix the core problem. Our system is watching this bounce with extreme caution. Relief rallies feel great, but they often collapse when reality sets back in. We need to understand whether this is a real inflection or just panic buyers stepping in before the next leg down. Let's break down what the data is actually saying under the surface. Price is $6.91, and we're literally at resistance. Our one target is $7.11, just 30 cents above. That's not much room before sellers show up. Below that, the 50-day moving average sits at $5.81, a 16% drop from here. The 200-day MA is at $10.76, completely disconnected to the upside. Price has already spent weeks below the 200-day, a classic sign of sustained downtrend. What's interesting is the entry zone we flagged, $4.18 to $4.31. That's 40% below today's price. Translation: the system thinks this bounce is a gift, and we should wait for it to fade before seriously considering a position. Support down at $2.37 is where the real floor might be. Another 66% haircut. Volume at 1.09 times average is mildly elevated, slightly above average interest on a relief narrative, nothing more. RSI at 60.91. That is neutral territory, not overbought, meaning this bounce hasn't yet exhausted the momentum, though it's getting warmer. The put-to-call ratio sits at 0.719. For every dollar bet on the stock falling, about $1.39 is betting it rises, which shows mild bullish options positioning after the CEO's reassurance. But that positioning is fragile. One bad catalyst could reverse it instantly. Implied volatility at 51.56% reflects the bankruptcy scare still baked into the market. Options are pricing significant uncertainty, rational, when the company was just rumored to need a bailout. No earnings date on the horizon means we're without a near-term catalyst to drive conviction higher. The system's low conviction tells the real story. These signals are lukewarm, and none of them scream this is a bottom. Here's the structural risk. A CEO denial of bankruptcy doesn't actually fix the underlying problem that sparked the rumor. Liquidity constraints, burn rate, the AV market's brutal economics. Those don't evaporate from one reassuring speech. If insiders knew a bailout was imminent, they likely wouldn't wait for rumors to force a denial. The relief rally we're seeing is pure sentiment reversal, not fundamental improvement. Second risk. The bankruptcy narrative resurfaces the moment LCID announces disappointing cash runway or another funding delay. When a stock has already fallen 79%, investors hunt for exits, not entries, and a bounce like this becomes a selling opportunity, not a buying opportunity. Without a clear path to profitability or a major financing win announced, the downside risk remains asymmetric to the upside potential. The options market is pricing in roughly 51.56% annualized volatility. That's elevated and reflects genuine uncertainty about the company's solvency trajectory. The mild bullish tilt in the put-to-call ratio 0.719 shows traders betting the bounce holds, but watch how fast that can flip. Call buyers today are paying for the privilege of owning this relief rally. If it fades, those calls expire worthless and put buyers profit. That 51.56% Roman 4 is where the signal lives. The market prices in a 1 in 5 chance of a move greater than 5% next month. With the stock down 79%, another 5% either direction isn't noteworthy on this volatility spectrum. That's how uncertain and volatile this name is. Smart money isn't using directional options here. They're either playing bankruptcy recovery binary bet or staying in cash. The options market's indecision mirrors our system's low conviction. Our system's read on LCID. Watch. Neutral bias, LOW conviction. The stock is tactically overbought into resistance at $7.11. The entry zone our model flags is $4.18 to $4.31. A 40% discount from here. Risk-reward is 0.02. Which is unacceptable. $1 of upside per $50 of risk. Until we see either a major financing win or a credible path to cash flow, the system is staying on the sidelines. This is a bankruptcy rumor bounce, not a fundamental recovery. LCID is a binary bet dressed up as a bounce. The data doesn't support conviction yet. Check the full dashboard for deeper dives on technicals, earnings calendars, and sector comparisons. And as always, this is our system's read, not investment advice. Do your own due diligence before making moves. Thanks for watching. AXON has dropped 5.82% in this session on just 0.32 times. Average volume, a warning flag right there. The bigger picture. This stock is down 42% from its 52-week high, which raises the question we're here to answer. Is this a capitulation flush or a rolling breakdown? Our system flagged AXON as a watch, meaning we're in reconnaissance mode monitoring for evidence of a bottoming structure before committing capital. The catalyst watch. Earnings preview headlines hit today, which means binary event risk is live. This is exactly the kind of setup where low volume and weak sellers can matter. The framework is simple. Entry zone marked, targets defined, stop set. The earnings clock is ticking. The technical setup tells a story of weakness probing support. AXON trades at $510.24, which sits below its 200-day moving average of $524.83. That's the long-term trend line. And we're below it. The 50-day MA sits at $467.92, now acting as intermediate support. Resistance lives up at $665.07, 30% higher. But the path upward is contested. Support is at $402.00, a 21% drop from current prices. The concerning detail: prices making lower highs and lower lows. Textbook downtrend. RSI 48.69 right in the neutral zone means we're not oversold yet, so there's room to fall before panic selling typically shows up. That lack of capitulation is why this is watch, not buy. Our system runs 25 plus modules on every stock, and AXON signal mix is mixed at best. RSI 48.69, that means the momentum meter is in neutral territory, not overbought, not oversold, just middle ground. Neither buyers nor sellers are in full control yet. Implied volatility at 0.5184, that's the ATM options price, needs to be interpreted against AXON history to know if premium is cheap or rich. The real tell is the put-to-call ratio at 1.113, which means for every dollar bet on the stock rising via calls, $1.11 is bet on it falling via puts. That's a slight bearish lean in positioning, not capitulation. The entry zone sits at $513.29 to $523.56, a tight band suggesting a potential bounce attempt if support holds. The headline today is AXON Enterprises Quarterly Earnings Preview. What you need to know: that means earnings are coming. And that's a binary event catalyst. Earnings days are where quiet holding periods flip into sharp directional moves. For AXON, sitting 42% below its 52-week high, an earnings miss could accelerate downside, while a beat could spark relief. The timing matters. If earnings hit before the entry zone solidifies, volatility will expand first. Our system tags this as a catalyst risk to flag, not a reason to avoid, just a reason to know the clock is ticking. Days to earnings is marked N/A, so check the actual earnings date. Pre-earnings entry is different from post-earnings entry. Information asymmetry changes the risk profile entirely. Put-to-call ratio 1.113, that means for every dollar bet on the stock rising via calls, $1.11 is bet on it falling via puts. That's a slight but real bearish lean in options positioning. It's not extreme panic, which would show 2:1 or higher P/C, but it's cautionary. The ATM Roman force sits at 0.5184, and without percentile context, we know absolute option premium, but not whether it's cheap relative to AXON on history. Critical context before sizing. For a stock 42% down and near support, Roman 4 levels matter. If earnings are imminent, Roman 4 will expand further as traders price the binary event. The R/R ratio of 0.17 tells the real story. Our system sees small upside targets against an $1.90 stop loss. That's why this is watch, not buy. The math doesn't justify aggressive entry. Our systems read on AXON: watch, neutral bias, moderate confidence. This is not a buy signal. This is a stay alert signal. Why? Prices below both key moving averages, not oversold yet. RSI 48.69 still has room to fall. Put positioning is bearish, but not panicked. And the R/R math doesn't offer compelling edge. The entry zone $513.29 $523.56 is a tight band right here. It acts as a trigger for a bounce attempt. IF support at $402 holds. Targets sit at $517 minimal, $625% up, and $737% up, but the stop at $420.55 is $90 away. That tight R/R is the caution flag. For AXON to flip from watch to buy, we'd need capitulation signals, RSI 30, positive news catalysts, or volume confirmation on a bounce. The earnings preview today is the clock ticking. AXON story right now is one of drawdown in search of a bottom, down 42% from its high, trading below both short and long-term moving averages, with bearish options lean and weak volume. This is a stock that hasn't yet given us the all-clear signal. Our system isn't shorting it. We're not piling in either. We're watching the entry zone, monitoring for capitulation, and keeping one eye on earnings. The key question: does AXON find support at $402 and bounce, or does earnings trigger a further flush? The data will answer that within days. For now, the framework is set. Entry zone $513.29 $523.56, targets at $517/$600/$700. Stop at $420.55. Volume must confirm any bounce. That's the filter separating relief rally from the real thing. Stay tuned and let price action tell the next chapter. Meta is 3.2% today at $643.52. Enough movement that our system flagged it as today's top attention name. Volume is running at 0.5 times the 30-day average. Here's what the data shows and why it matters. Meta is currently at $643.52. Key levels our system is tracking. Support around $540.18. Resistance near $686.08. The 50-day moving average sits at $604.14. Providing context for the current move, our analysis modules are tracking Meta closely. RSI is at 55.65, neutral. The system's overall signal read is watch with moderate confidence. Here's the story behind the move. Meta's data center plans could help solve its AI spending problems. That's the kind of catalyst our system watches for, the thing that can push Meta further in either direction from here. The options market shows a put-to-call ratio of 0.533 for Meta. Bullish. Implied volatility is at 28.9%. Our system flags unusual flow as a directional signal. Our system's read on Meta. Watch. Data-derived entry zone. $595.91 to $613.79. Stop level. $549.95. First target. $686.08. Risk/reward ratio. 0.5. This is automated output, not personal advice. Always do your own research. That covers Meta for today's automated scan. Stay tuned for the next name our system flagged. Like and subscribe for daily market analysis. That's our top 5 for today, all generated by an automated analysis system. This is educational content, not financial advice, and not a recommendation to buy or sell anything. Always do your own research. Like, subscribe, and set the bell so you never miss a daily brief.